Well, welcome everyone to June's meeting. In honor of June and it being home ownership month, we decided to feature all things homeownership in the IE. So to start us off, we have just a short presentation on what's happening in the IE, kind of like a reality check of what does homeownership look like and what are we seeing. And then we have a panel discussion following that, and then a spotlight highlighting some of the recent homeownership programs or the homeownership programs in our region, highlighting their work and what they've done. So I'll kick it off. I'm going to hand it over to Jay, who's going to start the meeting off with telling us a little bit about homeownership in the IE. So I'll get the presentation up. Thanks, Jay.
Thank you, Melanie, and appreciate you taking care of showing the slides that we've got here for our PowerPoint. And it is exciting to see where we are. Some of the numbers may seem a little daunting, but there are many things that people are doing, ways that people are able to work within the the overall housing market, either through affordable or market rate programs. And so I just want to take a quick look at where we are right now and kind of get a dipstick of the current conditions, where we have been, what the changes are. And so let's jump right in. Over the last 25 years, we've seen quite a few ups and downs in the overall economy as well as the housing market. From the year 2000 up through 2025, we've seen .com come and go, the Great Recession and the pandemic and a variety of other things in between that have all impacted us, as well as the Fed adjusting rates up, adjusting rates down, leaving rates steady. So back about 25 years ago, median price that we saw for a house in the Inland Empire, 144,000. And that gave us, depending on the individual, monthly mortgage payment around $1,000 a month. You can see the number there. Some were a little higher, some were a little lower. But that's where we started out the new millennium. And within 25 years, we've had over 300% growth in the price of homes here in our Inland Empire region, up to nearly 600,000. Um, and that gave us an average monthly mortgage 3,500, 3,600, somewhere in that range. And we have disclosed the interest. Now, these are just plain vanilla numbers, no HOAs, no Melleroos, no um, extra fees of any kind, just a basic, simple mortgage. And so that's grown about 360% over the years. But let's look at how that compares to the median household income and the affordability of the average market rate home within our region here. So I'm going to jump to our next slide there, Melanie. So that $144,000 home um, means that we would need an income of around 39,000 to afford that, so that the monthly housing payment was within that 30% range that everyone is shooting for, to ensure that our households are not overburdened by the costs of the housing on a monthly basis. And median wages were just a little bit above that. So they had an extra 200 to 300 a month if they had the median household wage. And some of those median wages came from single income households and came from two income households, but averaging out across everyone, they were able to manage in a reasonable manner in the year 2000. Now we move up to 2025 with the home price almost 600,000. Um, you would need a household income of around 141,000 a year uh, to afford a home and keep those housing costs within that 30% range. And so we're seeing a lot more of our population burdened by housing and many not able to move out of renting a home or a multifamily apartment um, because of the cost of either the down payment or the monthly payments. So, in order to afford that monthly payment, um, we're short about $4,000 a month for the average household here because the average is right around 93, 94,000 as of last year. And it's grown a little bit, but not too much. Now, if you go and look at those numbers and try to figure out where those numbers came from, our census figure will give us numbers for our MSA here in Riverside and San Bernardino counties that look higher than that. And that is because we have around 400,000 to 500,000 people whose wages do not come from employers in the Inland Empire. They come from employers to primarily to the west and south of us in LA, Orange, San Diego counties, where wages are significantly higher. And so they have seen challenges in getting housing there. They have brought their higher wages into the Inland Empire over the last 25 years and help to outcompete our local workers for the available supply of existing and new build construction. So it's caused it to have some challenges for our local population. So let's move to that next slide there about the down payment. So a down payment in the year 2000 was under $30,000, and seems like that's something that a lot of families could reasonably pull together. 25 years later, it's all bumping up to almost 120,000. So that's a significant increase in being able to come up with that down payment. And thus the need for many of the programs that we're seeing with the down payment assistance. And we're also seeing other popular options where we go all the way down to 10 or 5 or even a 3% down, or those that qualify for a VA loan can get a 0% down. So that helps a lot. And as we mentioned, there's the one income versus the two income households. Obviously, a we've seen a lot of growth in households occupied by just one person, significantly higher growth in that segment than in um, multiple occupants in a household. That has a moderate amount of growth, but the highest growth was in the single occupant household, which means it's very difficult for that single occupant to have two incomes. They have to work really hard if they're going to have two incomes in order to compete with our two income households. Um, and so that's one of the realities that we've seen. And it's gone on from probably around the 1970s up through today and caused a number of economic impacts in our region as well as in our nation. And so the one income household um, basically is whatever the median wage for one job is. And I believe that's a few thousand less than the median household income. And so in a two income household, they do have many more options and can work to either improve their education or improve their qualifications to get a higher income. Of course, one income households can do that as well, but the two income households just have more flexibility in order to accrue a down payment, get help from family, a whole range of things. Now, the biggest issue that we're seeing is the coastal prices for homes and their income versus our inland prices. Um, what we're seeing right now is around an average in Orange County of 1.2 million. So just about double the price for a median priced home in Orange County, and LA County is just a little bit behind them, bumping up close to 1 million. And so it's significantly higher, which causes a lot of not just middle income, but also uh, lower income as well as middle income households to look here in our two counties at our lower prices and consider should we make that 2 or 3 or 4 hour daily round trip and become a commuter, and come and purchase a home here. And even our rent rates have increased because of this factor. We just recently saw that Riverside, the city of Riverside, had rent that was approximately the same as the city of Long Beach. And so we're seeing some of the factors even out, but others not. At least as far as rent, it's beginning to even out somewhat across the entire region. Uh, Home prices for purchasing, though, continues to stay much higher. And so just look at that last slide that we have there, and then we'll move on with our uh, next features for the day. But there's a number of programs. There's down payment assistance from a number of government organizations, nonprofits, banks, and credit unions often have their own programs. But even for new builds, builders or their affiliated mortgage companies are offering many incentives for those new builds, which is kind of hard for the owners of existing properties to compete with those. We'll hear about an organization that has been a prominent in the sweat equity types of programs. And then there's also many community land trusts and affordable builders who are helping with both rental, multifamily situations, but also the possibility of home ownership in an affordable range, and some shared ownership models. And we encourage people to talk with the HUD certified financial counselors in our region because there are many options that come and go fairly rapidly. And you want to make sure that you have everything ready to go well ahead of time so that when those opportunities do open up, you can make a quick move into home ownership if that is what the individuals would like. So it's very quick and rapid, but a lot of opportunities as well as some challenges. So Melanie, let's go ahead and move on with our next feature here.
Thanks, Jay. There we go. Thanks for kind of sending the groundwork. And we have brought in two panelists today to help talk a little bit, talk through it, kind of provide a little bit of context to what we're seeing and a little bit of narrative to that. So as I kind of fumble through this real quick and get my screens up, we're good to go. Awesome. So I'd like to welcome on today, we have our first panelist, we have Claudio Espino, who is here from credit.org. He's the manager of the counseling programs and outreach at credit.org. And then we have Fabian Casarez, who is here. I saw him, there he is. And he's been in the region, been doing housing work. And he here represents a home advocate in the region. And so to start off the conversation, um, I wanted to talk about what are families experiencing right now. And so I'll go to Claudio first. And so from your perspective, from your as you know, as home buyers enter the market, what are their biggest challenges that households are facing when they begin to think of home ownership? So as they begin that journey, what are some of those biggest challenges that you're seeing as a HUD certified counselor?
So from the work that we do with home buyers, the biggest challenge is affordability. Home prices, as you know, we saw on the previous screens, are a big challenge. The interest rates, insurance has gone up as well too, and overall everyday living expenses have all gone up. And so many families feel that homeownership is out of reach. Even if they have stable incomes and stable jobs, they feel that homeownership is just not there for them. And so we see people that they also think that they need perfect credit and a large down payment before they even start the process. So that discourages a lot. So mainly what we see is the affordability issue, which is, big. And then also the fact that they think that they need a perfect credit and a large down payment to even start the process.
Mm. Yeah, I agree. And to Fabian, are these, some of the same challenges that you're seeing among buyers in today's market? Um, and how have those challenges evolved over the last few years?
Affordability is always going to play a major role because that's something that we're experiencing right now. Cost of living, interest rates still high, property values, although they've been correcting themselves, they're still at a higher level than the average homeowner can afford. But I think many of the consumers today lack the strategies that they need, the education, the information that they need to see what the options out there for home ownership. We look at families that we speak to consider that maybe by themselves, if they don't have a dual income, or even with dual income, it's still minimal, that they may bring in we call generational buyers, that they may bring in family members that will help them qualify for the loan. And we're starting to see, many generational purchases happening where, brothers and sisters, children with their parents are buying their homes, creating alternative methods of being able to qualify for a home. But many of these individuals out there don't really understand that these possibilities exist or how to even strategize that. So it's paramount that many of these individuals speak to the right individuals that are going to give them the knowledge, the direction, the opportunity to do so, because just your traditional real estate in today's market is very, very difficult for home ownership today, being that there's very little down payment assistance, being that the cost of living is so high. One of the major factors is immigration, especially families that of a minority background, that they just don't know what the restrictions are, even the guidelines for purchasing a property, through FHA. A lot of foreign nationals can't even buy anymore. Some of the DACA recipients aren't able to use financing anymore. So it's really comes to education, information, and really sitting down and evaluating what options are available and what alternatives can be presented to these buyers that they may not even consider. And you cannot assume that your traditional realtor or lender are going to be capable to provide this information, because that's not just what they do. This is being part of a realtor, a lender, an economist, a counselor, kind of all put together to be able to convey this message and information to these consumers.
So what it sounds like I'm hearing is that home ownership is still attainable, right? So what are you seeing, Fabian, as some opportunities in the Inland Empire? I know you kind of touched on it, but maybe to dive a little bit more into that, how are successful buyers adapting?
Preparing themselves, really not being impulsive, preparing themselves, understanding that home ownership may take them 3, 4, 5, 6 months. And what do they need to do within that timeline? Pay some credit down, fix their credit. Again, talking to a family member to maybe be a co-signer with them, looking at properties that are more affordable. It's that old saying, you got to drive to thrive, where individuals want to be in certain areas that they just can't afford. You may have to go in the outer boundaries of the Inland Empire to buy. As the market has gone up, you're going further and further east. We've got buyers now that are going to Barstow, buyers now that are going to Coachella. and even those areas now are kind of picking up the slack where those areas are going up in value. So it's creating the expectations that are realistic and preparing them and kind of giving them the big picture. This is it's going to take you, and kind of putting a timeline together for them. And how long is it going to take you to do this? And then when you're ready, these are your realities, because we get a lot of buyers that come in and, I want to go buy a property at 450 and I'm living in Ontario, I'm living in Chino. That's not going to happen. And if you're not going to be able to go to, Murrieta, Temecula, Lake Elsinore or Victorville, chances are you're not going to be able to find anything under that 400, 450. And even that number is still very difficult to find in those areas that we all know now. So yes, there's still opportunity out there, but it's not as easy to obtain as it was in the past years. Now you need strategies, you need a plan.
Yeah. Yeah. And so, to Claudio, I know Fabian mentioned some of the, steps or ways that people can prepare, but from your perspective, how can individuals and families now position themselves to take advantage of different opportunities? As a housing counselor. Sorry.
Those who are succeeding today are the ones that are well prepared, like Fabian said. And so some of the steps that these people who are successful, and especially in the IE, is that they worked on their credit, they build savings, and of course, reduce the debt. And the other layer that Fabian talked about is that they learned about the programs that are through the housing counseling agencies. And so my advice to homeowners is to focus on what they can control, improve the credit, save money consistently, and avoid unnecessary debt. So even if home buying is a few years away, the steps that they take now, just the building blocks, can help them make a real big difference in the future and how long it's going to take them to get into the home.
So having experienced that and talking, locking arms with people, home buyers in the community wanting to buy, what are some of the most common misconceptions about credit or down payment or just being financially ready? What are some of those misconceptions you hear when you meet with individuals or families?
I would say, the biggest myth, I'm sure Fabian will agree, is that the biggest myth is that you need 20% down payment. And so many mortgage programs allow much lower down payments nowadays. And there's assistance and programs that may help borrowers get qualified. Another misconception is the credit score. And so that they need a high enough credit score to even start the process. And then on the flip side of that, they also think that the credit score is the only thing that matters. But we need to educate consumers that lenders also look at the income, the debt, the savings, and the overall financial stability of the individual so that they're able to get into home ownership and reach that goal. And so I would encourage people to seek counseling early. The sooner they understand their financial picture, the more options that they have so that they're able to get to that goal.
Great. Now, to Fabian, how do you see those misconceptions affecting buyers during the home search or during the purchasing process? Anything that's different, and how is it affecting them?
I guess the resources that they're listening to. There's a lot of marketing out there, a lot of misleading, a lot of fraudulent information out there that says you can buy a home with no down. You can do this and you can do that. So these individuals, when they come to us, this company said you can do this, and this company you can do that. And I said, you know what? They may say what they want to say, but at the end of the day, when it comes time to originate the loan, that's not possible because there are guidelines. Now, there are certain products and certain programs out there that do allow for, at least 1% down contribution. But for the most part, it's going to be 3.5 FHA or VA no down if you're a veteran, or your 3% Freddie or Fannie, home possible home ready products. So I get it comes down to a lot of misconception, a lot of misinformation on these individuals. There's a number of individuals that think that you have to come in with a big down payment. But, I think in our arena that we're looking to the low to moderate, we're looking for the first time buyer. We're looking for those recipients that are looking for down payment assistance. They're coming in with the attitude that they don't need no money down. They're coming in with the attitude that, I qualify because I'm this, I'm that. it just goes back to the right information and the education, because I say no to more families than I say yes to, unfortunately, because their ask is just unrealistic. It's just not the reality in the mortgage space right now. You're starting to see credit tightening up with the lenders because the foreclosure rates are going up. That lenders now are really, really focusing on a high leverage buyers, meaning FHA or Freddie Fatty 3% down, or even VA, because those individuals who just bought, I'll give you a statistic. Many individuals who just bought between 22 and 25, and they bought Freddie Mac, Fannie Mae, Home Possible, Home Ready 3%, or even 5%, or FHA, they're already a short sale. People don't even realize that. They're already underground because the market has dropped, and it will continue to drop. And to try to refinance the property, there's no equity. If the rates go down, the only benefit for an FHA in part would be the FHA streamlined. It's just a determined rate. It's not based on an equity position or credit, whereas at your conventional it would be. So those are the families that are right now trying to struggle, that are trying to refi. They can't, because there's just no equity position. Plus the rates aren't really, that big of a difference compared to, a year ago. Many of them right now, we're looking at them with short sales, that they're already underwater. It's already started. I know that we had conversations that I spoke a year ago where we're saying, get ready. Well, it's here. It's here now. And so, again, just going back to that, it all plays a role. They're all interconnected with each other.
Totally agree.
Yeah, so it sounds like information, and just in making sure that in your roles or folks as they're entering, or as they're looking, prospective homeowners, is they're really taking the time to be diligent and understanding how they qualify, how they can become best financially suited for that, and what programs can they access, whether it is the Home Ready at 3% down, or that they don't need 20%. Maybe they could do a 5% down and get their foot into the door of homeownership. That those are misconceptions about what is available for first-time home buyers, and our 80 to 120% AMI buyers, that this discussion is kind of surrounding right now, are those types of buyers. So
Can I just say something? It's funny. I wanted to say something, that although we deal with a number of buyers, we do have buyers that do have a good amount of savings. And I've noticed in the last year, more so than in the past, that these buyers that do have 20-25% down, more than happy to put that money as their down payment in the past, so they would eliminate the PMI or MI or what have you. But the feedback I'm getting today from them is, Fabian, I'd rather go down as minimal as possible, because with the cost of living right now, we need reserves. We need to have money for that rainy day. We don't mind having a little higher payment, but knowing that we have money in the bank, because with everything going on right now, we may not even have a job a year from now, 6 months from now. And if we don't, we have enough reserves to carry us for, 4 or 5 months. So that's a conversation that I've been hearing more and more from consumers that do have that money. When we're pre-qualifying them, and I see the proof of funds, and I see that they got the 401ks or annuities or savings or whatever they may have. And I'm asking them, well, why won't you put a bigger down payment? And it's been the same common denominator more and more as we go on this year. Another thing that I wanted to mention, that as far as affordability was concerned, there's a misconception of information out there that they say that we have lack of inventory. We need about 4 million homes to cover that lack of inventory. That statistic is very misleading, because the real numbers, at least from what I gather, is that 70% of homes in America today are just unaffordable to the average buyer. So that eliminates 70% of the inventory. They're saying right now that if we were trying to facilitate home ownership for families, it would probably be somewhere about 350 to 400,000 homes that we would have to make to facilitate those buyers that are ready today. And it comes down to, again, the affordability, where there's just not inventory out there for these families based on these type of prices, where they said that average price would be about 280 to 310. So those are the numbers that we deal with as far as when it comes to availability, and then also the price of inventory that would have to be there to fulfill that space of lack of inventory.
That's a great point, Fabian. And I think that's why, within the housing collective, why we've started to frame our conversation on how do we talk about the housing continuum, right? Understanding that we need a certain amount of housing types at all AMIs and at all stages of someone moves through this housing continuum. So we do need deeply subsidized affordable housing. We do need emergency shelters. We need transitional, permanent supportive, and also need that affordable home ownership, right? That niche. We need to make sure that we're not just building luxury homes or homes that might be affordable, but then with high HOA fees, then it makes it unaffordable, or high Melrose, which makes it unaffordable. We need to ensure and be thoughtful about how we're building and that housing and make sure that as someone moves through a housing continuum, there is enough units available for each of these stages. And that's where we're also seeing is this kind of bottleneck too of it's hard for folks to attain home ownership because there's that bottleneck, or folks to actually maybe downsize and maybe become renters again, or maybe downsize in terms of a house and unlock a larger home for a family because these costs are so and the interest rates are so high that it's harder for folks to make those transitions and unlock different housing opportunities as someone moves throughout their life or their housing continuum, whatever that looks like. So, yeah.
Absolutely.
Mhm.
And then also the baby boomers, they're just not moving out of their homes like they have in the past. Why? Because they're starting to see a lot of the family members move into the properties. Now their kids coming out of college, they're young married couples that cannot afford a home. I've had a number of families that I've talked to in the past that we follow up to try to do a reverse mortgage. At one point they wanted to sell. Now they want to do a reverse mortgage because now their kids are going to live with them. So that interest of selling their home and downsizing has changed now. That trend is now more along the lines of we're not going to sell. And that's also hurting the inventory for affordability in some areas because these baby boomers are not downsizing no longer. They're staying where they're at. And for many of them, they're either paid off or have a very low mortgage payment that they could not even go rent to downsize. It would be more expensive to rent somewhere than it would to stay where they're at, assuming they still have a small mortgage payment and they're paid off. So, those also play a role in that affordability of inventory.
Yeah, so we've kind of moved into a conversation of this bird's eye view of housing in general and affordability. So to kind of bring it back down to that local direct conversation of how do we work with home buyers? How do people attain home ownership? Fabian, I want you to answer. What are some of the emerging housing types, communities, or strategies that people that are helping that help more people enter home ownership?
So you have Lennar Homes and D.R. Horton that are right now in the project stage of building tiny homes with lease option to buy, to put families in the property with lease option at affordable pricing that will give them the opportunity of home ownership in the future. In part because their inventory is not moving and they need to re-strategize and figure out a new way to reallocate some of their inventory. So that's going to be one of the new ways that we're going to see in the near future of rent to own. We're starting to see more of that right now on that. You had through the Casita Coalition, they just put out their newsletter for those of you that participate in that. They were talking about FHA creating a product that would allow families to refinance or finance their property without having to refinance their FHA loan, to pull money out to help them build ADUs or secondary units in the back to create more housing, affordable housing, so that they can bring in, more rentals, more income. Strategies like that are going to make the difference for housing, unless the market drops 15% and the rates go down to 5%. Nothing's really going to change because affordability after COVID just got out of whack, and the average American, the average homeowner just can't do it anymore. The average buyer just can't do it anymore. So unless we start looking at ancillary types of opportunity to down payment assistance, to subsidies, to certain type of communities that are going to be built for these type of families, I really don't see any major change. I see everybody talking about it in paper and white paper. It looks great. And these are the topics of conversations and everywhere we go. But it's just not being implemented. It's all based on theoretics or hearsay and what may or may not happen in the future. So I haven't seen really any big proposal, excuse me, that I could say this is the answer. I still think this is still a few years away before we see anything. And I think that the builders are going in the right steps just by default, but at least it's something. At least it's something because I mean, you can keep on going further east, But for any of you that know Coachella or even know Blight or know those other areas out there, it's very difficult. You're out in the desert and then you got a water shortage issue out there. So that creates even more of a problem depending on where you can build. So,
Yeah.
so it's a challenge all the way around.
Yeah, we have some of our partners from Lift to Rise out here who strongly represent, the Coachella Valley and definitely understand that as they look to build more multifamily, uh, deeply subsidized housing out there, utilities, water, all that's always a challenge for them as they, help the cities in the region do that and try and create processes and strategies to help just accelerate that besides just capital, but intentional strategies around that. So infrastructure is huge. To Claudio, what programs or services or resources are out there from your perspective as a housing counselor that an aspiring homeowner should pay attention to or should know more about um, that can
And
help make those options a reality for them?
I think specifically in the Inland Empire, we have a lot of organizations that are working together, such as this one here, and they're sharing information to bring the homeowners beyond, just knowing the basics. There's more resources available than many people realize. Like Fabian was just talking about the one program. And so organizations like credit.org offer free home buyer education. On top of that, we offer the one-on-one counseling, and so I would say that the counseling that we provide with credit, budgeting, and of course exploring those mortgage options and the steps involving to buying the home is a good resource. There are a lot of down payment assistance programs and affordable loan programs and local resources. And I think with credit.org and being part of this collaborative, we get ourselves informed so that we're able to get that information out to the individual who is seeking, a first-time home buyer opportunity. Beyond just the credit, beyond just the budgeting, we want to talk about specific programs that they may be eligible for in the IE. So we try to verse ourselves with a lot of the information so that we could bring that and educate our homeowners, and that only happens through our partners and our collaboration that we have with one another.
Yeah, so it definitely sounds like we have 12 certified HUD certified counseling agencies here in the IE region, and I see a few on here also represented, credit.org being one of them. And it sounds like there's even an opportunity for our HUD counseling agencies to even work together to understand what programmatic opportunities or resources they have, right? Because that partnership, those collaborative spirits with lenders, with informed realtors who understand an entry-level buyer, who understand DPA, there's an opportunity for all those collaborations to help increase the ability of our buyers, our first-time home buyers, our 80 to 120% AMI buyers entering, the market. So if you, Claudio, if someone was listening today or someone listens to this later on, what are some next steps? What are some things someone can do if they want to be a homeowner in the next 3 to 5 years? What are some high level, maybe some just quick next step tasks that they could
So
do?
the biggest thing is, and the number one call to action would be start preparing now. Review your credit report, create the budget, build savings, and of course, pay down high interest debt. The second thing is learn about the programs that are available in the area. There's programs that are national. There's programs that are at the state level, county level, and city level as well too. So learn about those programs. Um, Speak with a HUD approved housing counselor because they're going to know and give you the insights of those where those programs are. And I would suggest to everyone that homeownership is a journey. And so small steps taken consistently over time can lead to the results that they're looking for. And so not to discourage or don't be discouraged, and to really think about it's a process and it doesn't happen overnight. And like we had said earlier, those who are succeeding and becoming homeowners are the ones who are prepared.
All right, to look a little bit more broadly at the IE, Fabian, what changes in policy, housing supply, financing, or just general community investment, what changes could help make the greatest difference in expanding homeownership opportunities for more folks?
You know, the one thing that's always helped us with the families when it came to this arena was always down payment assistance. We've layered 4, 5, 6 different layers to get a family into a home. That's just the nature of the beast. Unfortunately, we've been seeing a lot of programs that we were accustomed to utilizing are gone. And the average buyer right now, 5, 10, $15,000 down payment assistance. Don't get me wrong, every penny counts, but anything under 25,000 is basically just closing costs for the most part. If you're looking at any major shift or any major benefit would be principal reduction. And that principal reduction comes with 50, 100, $200,000, especially in California in the IE. So I would say that, right now, there's not a lot of down payment assistance being offered. There's a lot of small down payment assistance, but, it's nothing that really makes a dent in the families that we could have helped, a couple of years back when there was, a lot more down payment assistance available. Unless something changes to that effect, the market really starts to correct itself at a deeper discount than it is right now, and we start seeing the rates in the mid fives to low fives. That's the tipping point of affordability, because for many homeowners, living at an 80% or 120% AMI doesn't get you anything unless you got 4, 5, 6, in the family, and even that, doesn't get you much. We were out in Murrieta, Temecula, and our tipping point was 420, 425 at best at 100%, 120% AMI. And it was very challenging for us. At an 80% AMI, it was just unrealistic. Those buyers had to go and either find a co-signer to help them buy or go back and save some more money or figure something out, because there just was no help. So I don't really see anything immediate. I think, again, just living within your means, preparing, saving, cleaning your credit, getting prepared, and hoping by the time that you're ready to engage in the market that there are programs that can make a difference for you to move forward. Because let's look at 2 years back, all the different programs we had. We had hundreds of thousands of dollars to give to families. Today we don't have much of that anymore. Who knows what will be a couple of years from now if things continue to go in the direction they're going now, with HUD being cut millions of dollars, all these different funds being cut for subsidies and down payment assistance. It's just going to be very challenging moving forward. I think you're going to see the number of homeownership go down and the percentage of renters go up, and we're already seeing that. It's already here.
So I want to just briefly mention you had said Casita Coalition earlier. I mentioned them, and Casita Coalition. They're not. I don't see them here in the room right now, but they do join our policy pillar, Educate and Advocate for Public Policy pillar. And one of the initiatives, I know Fabian, you're on their board. I know one of their initiatives is really strongly encouraging cities to adopt AB 1033. Because I see a few city folks on here, and I wanted to level that up too, because that isn't also an opportunity, really honing into that ADU, the casita in the backyard of a split lot through SB 9, and then AB 1033, which cities, it's not a state policy, but cities can opt in, which allows folks to build an ADU in their backyard and to sell, right? And so the 1033, if adopted, they can sell that at a first-time home buyer. So it's really unlocking that opportunity to build densely, still in a single family, maybe residential area. Also allow for those opportunities where maybe there is generational living, and someone wants to maybe a child still wants to have home ownership opportunities in the ADU they can still buy. So there are policies that are slowly moving that are it may not be able to, be replicable and produce a lot of units in a big push, but It's very innovative. It can move and it fits for some communities well, and can fit for some and that want to take advantage of it. So it's those little snippets that we got to keep track of, that we got to encourage our cities and encourage others to consider too. So to wrap things up, I have 2 minutes and then we're gonna move over. But real quick, our closing, for both panelists, homeownership has been long viewed as a pathway to building wealth and sustainability. So despite the challenges that we've talked about today, what gives you hope about the future of homeownership in the IE? And what message would you want to leave with anyone who wants to aspire to be a homeowner, if not yet a homeowner? So to
Well,
Fabian and or to Claudio. Yeah.
so I think ownership of a property is always the American dream. People desire to have home ownership. It creates security, creates stability. It creates a sense of accomplishment to come and say it's my home. So I don't think that dream will ever fade out. I just think that as time goes on, it's just going to be more challenging to attain, and we're going to see less families engage in it unless something changes in the near future. But I think homeownership is always going to be a priority to everyone. It's just going to be based on what programs can individuals engage in to make that a reality. And for many of those who don't, they're just going to be, we're going to become, and we are becoming, a nation of renters. And it's just a reality. Individuals looked at home ownership as it was a right. And, to me, home ownership is a privilege. And with privilege comes sacrifice and comes a lot of other things to make it happen. And I think the days of it's my right to be an owner are changing now to it's a privilege to be a homeowner. And these are the challenges and the obstacles you're going to have to overcome to be a homeowner.
And just to bounce off of what Fabian's saying, we see homeownership from the counseling level as homeowners and individuals and families are still determined to reach that American dream. Even with the challenges that they face, they're still working hard. They're improving their finances and they're planning. And so my message is simple to give to them is don't give up. Start where you're at right now, build a plan, and keep moving forward. Homeownership may take some time, but eventually, if you have that goal, you will reach it at some point.
Ayako, you have a question. Go ahead.
Yes, thank you, Claudio and Fabian, and Jay, for that presentation. So timely. Yes, so there are a number of public down payment assistance programs such as HUD's Cal Home and HUD's Home and California's Cal Home, and other DPA is focused at 80% AMI. But we know in California, i.e., 80% AMI family of four is really a mortgage of maybe $180,000, give or take. So if median prices are in the 400,000 or 500,000, that's a very, very substantial gap. But these down payment assistance programs, the public ones, are 80% AMI. So how are we going to come up with this gap when so many of those public assistance programs don't really allow, 6 layers of liens? That's what we need. We're finding Mary Erickson Community Housing, and I know everyone else on this call, if we want to do 80% AMI housing, we need 6 layers of liens in order to make a down payment work for 80% AMI. But these sources want to be in second or third lien position. So then that makes it not possible. So this would be an ask of the policy committee and this general group here. How do we put pressure on our electeds, on the state government, to make the publicly available down payment assistance sources more flexible by not requiring that they be in second or third position, that lien position, that they be allowed to go down? Then maybe we could cobble together 6 layers of liens to make home ownership more possible. But if they only will allow, if they have to be second or third, then we don't have a deal. So that's the public policy push I'd like to ask of this group.
I love it. Thank you, Ayako.
Yeah.
We'll add that to the agenda to talk about that. I mean, that's something that we've talked about, but maybe in this next year we could talk about a more intentional strategy and discussion with those from Sacramento as we're building and bridging that relationship.
Yeah, awesome. And just for a thought, Cal HFA has, mortgages, but they offer that My Home down payment assistance is 3% of the purchase price, but they have to be in second position. Well, again, that doesn't work for 80% AMI. Cal Home, they want second position. They'll willing to go to third, but you got to really negotiate. So anyway, they just need to make this so much more flexible. Then we could get more 80% AMI buyers into home ownership. Thank you.
Yeah.
So Mel, one of the things that we've talked about, that if there was a way to create a fund or get funding that would not register as on the DTI, meaning that because there was no payment for 5 years, like a lot of these different down payment, some of these down payment assistance where there's no payments for 5 years, it does not create a payment shock, and that would not be factored into the DTI. So by offering individuals at an 80 or even 100% AMI and providing some of these programs that don't register up to 5 years, there's no payment shock and it's not factored into the DTI, they can qualify for more. But again, it comes to being creative and alternative types of financing, because it's going to take programs like that are really going to make a difference. This is why down payment assistance works, because a lot of the monies that they're receiving are silent. Yeah. So there's no payment shock there, but it's a minimum of 5 years. And we're starting to see that, for any type of programs out there above and beyond, a lot of the down, the regional or local down payment assistance programs, they don't do that, and we can see on that, as Ayako said, with these different subsidies and grants, or not even grants, but down payment assistance, they don't want to subordinate because of the risk factor. So unless somebody is not securing that on the back end, it's kind of hard, because everyone's fighting to be in that first or second lien position. They don't want to subordinate because the risk factor increases as you go up the ladder. And with prices changing, that property, years from now can be underwater. And now that fourth or fifth lien is wiped out if it's not forgiven. Yeah.
I see.
Yeah. But again, it's those type of programs that don't register for 5 years that can make a difference, because it would not do the payment shock and it doesn't factor in their DTI.
So it's a 5-year deferred?
The payment, it can be a 30-year loan. You just can't collect any payments on it for 5 years. On the 5th year and the first day, you can start collecting, that first month, you can start making that payment, and that's fine. Usually by that time, the premise behind that is they can refinance, because now they earn some equity. The market has shifted, and now they can refinance it if they choose to do it. That's kind of like the big picture on it. You don't necessarily have to, because usually when you have that, individual refinance to get a blended rate, which would be lower, because usually these will be a little higher rate. But it gives them 5 years to figure it out, and it gets them to a home, and it gives them an option. Otherwise, you're just going to keep on renting. So these are alternatives that if there was funding, even governmental or private funding, or through some type of subsidy or something or another, doesn't mean it's going to be offered to everyone. But if you can put 10, 20, 30 families, just like the Dream for All program, they came out and did this program, and, you only had a certain amount of families that took advantage of that. But those certain amount of families were able to get home ownership, whereas in other cases, they wouldn't have been able to.
Yeah, I got it. Okay. Yeah, that's definitely something to consider and to think through, those types of those different strategies that could unlock more opportunities. So I saw, Liliana, did you have a question? Did you want to jump in? I was going to let you take the last question before we transition.
Yes, Melanie, I do have a question. And actually my question is based on a conversation that I had with a resident. She expressed that she wished she would have been born earlier, so that she could have made it, to a prime time where like housing was still affordable. And so I just thought that maybe the facilitators could share maybe what advice they would have for that younger generation that's coming to inherit this housing crisis, or perhaps what supports and resources are most valuable to that generation to ensure that we're positioning them in any track, right, to be homeowners in their future.
I could answer that if you like. So when I do the homebuyer education and I talk with younger millennials or Gen X's or Gen Z's, I tell them the first thing they got to do is be realistic. They got to live within their means. They cannot have a Mercedes-Benz taste and a Volkswagen budget, because if they continue to live a lifestyle that they want it now and they want everything, they're never going to own. And right now that they're young, they have time to save. They got time to really work hard so that they can have the opportunity for ownership. When I bought my first property, I remember I was 22 years old. I was a condo. I bought it for $76,000. Okay. And to me, I saved. I saved my money. I lived within my means, and my priority was to have home ownership. And I had to sacrifice a lot. I had to sacrifice not having the cars that my friends had. I had to sacrifice not being able to wear the clothes or the jewelry or go to the dinners or do this and that, because I was looking at long term. I wasn't looking at a quick fix today. And this is what I convey to the younger generations. I convey to my children that everything is based on your ability to be realistic, to live within your means, and to understand that there are reactions to every action you take, positive or negative. And if you create a budget, stick to your budget, create a timeline, a mission statement, sub goals and goals, and you stick to them, the probabilities of accomplishing homeownership are much more broader for you than they would be to, say, one of their friends. But it's a lot of hard work. And in terms of pricing, $76,000 to me back then was $1 million, because I was a young kid, and that was, it wasn't cheap. That was just a going rate. Today, what you're experiencing is just the rate today. Let's say, for example, whoever buys it 5 years from now, that $400,000 home, if everything continues to go, will be 700,000 or 500,000 or six, whatever that number may be. It's only relevant to the time. And yes, we've outpaced expenses to our wages, but there's still many families buying because they're living within their means. They're having a goal. They're setting their priorities, and they're living, and they're making it happen. It's just going to take them longer than it maybe took us. That's how I convey it to the younger generation.
Mm. Claudio, do you have a minute response, quick response?
Yeah, it's just the same thing, and layering on of what Fabian said is home buying is a journey, and so wherever you're at, you have to have that plan. And like Fabian said, make the plan, make the goal, but the important thing is to revisit, make adjustments as you go, because life does get in a way, and so you want to make those adjustments as your life goes as well too, to be able to reach that goal.
Okay. Well, thank you guys for coming. I really appreciate you spending some time and talking through this. And this isn't the end of our discussion or our agenda for today. I just wanted to thank you guys both for jumping on. I really appreciate your feedback. Both of you have a depth of experience, and that's why I wanted to invite you guys to come and kind of share out, two different perspectives, two different niches of the home buying process, of locking arms with potential home buyers. And so I really appreciate you coming and sharing with us. And so we're going to transition to our next speaker. And I was excited. I had saw this through a newsletter and was excited to follow up with Kari on this. Kari is from the Director of Family Services and Education Programs at Habitat for Humanity. And so they had a recent home buyer come in and buy a home that they had built. And so I have a presentation I'm going to put up, but Kari, I'd like to welcome you to kick it off and share a little bit about this recent this recent success, this recent story that we wanted to elevate, especially because Habitat for Humanity serves, it's such a unique program, a unique home ownership program. And really, Habitat is, I know, an organization that really represents and is trying to figure out what wealth building programs, how they can help families really build generational wealth through home ownership. And you guys and Habitat does that through home ownership. So I'll let you kick it off. I'll get the presentation up.
Thank you so much. I did want to just share. I got more and more excited to share because of the conversations and some of the points that we were all trying to make about how challenging it is in this market. And I know that, and I understand why it can feel very doom and gloom for a lot of our folks. But I think what we're trying to do at Habitat, and I know a lot of the other affordable housing nonprofits here and not with us here today, is just trying to give folks hope. I think if you were to ask me what Habitat does, I think Habitat gives individuals and families hope, because it is possible. Our affiliate only covers a portion of the of the Riverside County. But are collectively, all of the affiliates nationwide and actually worldwide, I think together are really making an impact. So I'm really excited. Yes, there's challenges, but there's also some solutions that I think are coming down the road, and I'm hoping that they turn into reality for us, and we have more housing and homeownership opportunity. But yeah. All right, so I'm actually going to share not of our most recent one, because we have not closed on that one. We're not closing till the end of this month, but I did get to meet Jay in person at the event. So I'm so excited to actually get that opportunity to see face to face. I try to attend these meetings as much as possible as well. But so this is actually us doing a house blessing at one of our it was in the last year. We'd closed on this home within the last year. And so that's just some staff, some board members, and then the Habitat homeowner over there in the front with one of his children. We can switch to the next slide. And so just really quick, if you don't know about Habitat, I'm just going to touch on it really quick. Habitat's vision is a world where everyone has a decent place to live. And then in the next slide, you'll see the mission of Habitat for Humanity Inland Valley, in partnership with God, is to facilitate the dream of homeownership as well as improve living conditions for those in the community. So we do also have repair programs that are available in some of the cities that we cover, and those are also serving low and very low income households, homeowners actually. And then the next slide is just going to be a little bit about our program. And you'll just need to click through. So it's designed to assist very low and low income first-time home buyers achieve their dream of owning a home. Interested families must first apply to the homeownership program and meet eligibility requirements. So we call it a pre-application process. We encourage people who attend our homebuyer orientation to submit a pre-application, regardless of whether we have an active home available for sale. And the reason why is that we don't want to wait until the home's available. We want to start working with families before the home is available. So if there's some debt issues, or there's some credit issues, or they need to save up for the $5,000 that our homebuyer, our buyer contribution requirement is, they can start working on that now instead of finding out that they're not eligible and it's too late for that particular home. So Habitat constructs and rehabs homes in partnership with the family, and the family invests in sweat equity hours to build their future home. In some cases, the homes are not new construction, and so that means that there's less opportunity to complete the sweat equity requirements prior to closing. But we have a very lenient sweat equity program. It does allow for volunteers to donate their hours to the family, and they are also able to complete it after closing. And really what we're trying to do here is build community and encourage volunteerism. As you know, Habitat depends highly on our volunteers in different areas of our organization. And then the last thing, if you want to click one more time, Melanie, is that homes are sold to the family and financed with affordable loans. So the next slide, I think it's going to be, so this particular Habitat home, I should have said homeowner, I apologize. I did change it a little bit because I didn't want to include any details as far as names, but he's a single dad for 14 years. He has 4 children, only 3 remaining in the household. Their ages are 23, 17, and 15-year-olds. And he's a Paris resident that works for the city of San Jacinto. He'd been a participant of the Section 8 program for about 7 years, and he was so grateful for that because he would not have been able to manage without the rental assistance. And he was actually referred by the County of Riverside Housing and Workforce Development. So we do have a partnership with the county and different departments at the county. And I think a lot of our clients' barriers are that they just couldn't afford the traditional mortgage. So he struggled. His why was that he struggled a lot, and he just didn't want his kids to have to go through the same thing. So I think the next slide is going to be actually some photos of him and his family. So on the left, you'll see that's the kids when they were younger, and this is a more recent photo of him and his kids. And so he did actually receive this home. So the next slide is going to give you some details about the home. The home is in Paris, and it was a $470,000 purchase. It's a 3-bedroom, 2-bath home built in 2004. It was about 1,283 square feet and just under 4,000 square foot lot. It is in a community, so although the lot is small, the community had all sorts of parks and clubhouses and all that great stuff that kind of makes up for that. We also did some rehab on the home to make sure that not only meets health and safety standards, but we also want to make sure that all the major components are going to be good for, I don't know, I'd have to check with construction how many years we want to make sure they're good for, and we also sell our homes with home warranties. And so the next slide, I think we're going to talk about financing. Oh, wait, no, sorry, some pictures. There's a picture of the home with, again, the same group of people. The next few slides are pictures of the interior. Kind of give you an idea of what we do. All right, so I think we touched on this a little bit, but we did have to do a lot of layering. I will say Habitat Community Capital is the first lender, and it's a 30-year low fixed interest rate. So we have been working. This Habitat Community Capital is actually a division or department of Habitat International, and so we have access to this type of funding. And they just reported to me that in this last year, their average, or I should say their range of interest rate has been between 5 and 5.5%. So kind of part of the solution that we talked about, right? We've also partnered or collaborated with Neighborhood Housing Services of the Inland Empire for their Cal Home program. And so Habitat is a participating lender for all of their loan programs. And so we're able to access their silent second loan that's deferred for 30 years at a 3% fixed simple interest. And then we also have a partnership with the City of Paris. We receive CDBG funding, and it allows us for about 2 homes for each allocation that we receive. So in this case, they also received a silent forgivable third loan, and it's substantial. It's up to $100,000, and you can also receive closing costs assistance if needed. And then the final layer is going to be Habitat for Humanity Inland Valley, and we provide up to 25% of the gap assistance. It is a silent deferred fourth loan, and there is a proportional equity share that is included. So you can imagine trying to explain all of this to our home buyers, but it takes it. We make sure we explain this when we present the homes, when they become available. So in our home buyer orientations, and then also again, obviously, when it's time to sign loan docs, that the families are familiar with the different terms of each of these different loans. And so on the next slide is really just kind of a visual to kind of show you, like, this is how you have to make it affordable, right? The traditional purchase, maybe you can get a conventional with 3% down and you're paying a mortgage payment on that 97% of maybe, what is it now, 6.25. But for a Habitat Rehab home, we're combining those different loans so that HCC first loan is the only loan that they are actually making a payment on. For this particular, actually, I would say for all of our homes in the last couple of years, since we've been doing the Habitat Rehab home and layering these programs, our homeowners' payments are anywhere from, I think it was $1,480 to 19 something. So under 2,000. All of our homeowners loans or payments are under 2,000. And that's how we make it affordable. I think the last slide I have is actually a video, but I don't know if, yeah, I don't know if you're going to be able to play it. Let's see if it works. We watch this video as many times as we need to. So when things get tough and we remember why we do what we do. So thank you so much for this opportunity, Melanie. And I guess if anyone has any questions, let me know.
Yeah, Pam, you have a question?
Yes. What's the minimum the minimum income required for your program?
So we don't have actually a minimum income, but we do need to make sure that after all of the assistance that we're able to layer, not even provide, because remember, you see there's other organizations that are providing the layering. They still need to be able to only have 30, sometimes 35% of their monthly gross income towards their housing payment. And we do have a maximum 45% back end ratio. So,
Okay.
and most of our programs have been 80%. Actually, I take it back. Most of our programs have been 50% AMI, but the most recent ones using these rehab homes have been 80% AMI.
Okay. Okay. Thank you.
Mhm.
Curtis?
Hey, Kari, good to see you. I
Curtis, so good to see you.
Good to see you as well. I just wanted to give you guys a shout out. So we had a home buyer education class here at City Hall last weekend and had some of your buyers for the Victory Village development you're working on. So
Oh
they
my
were
gosh, that's
super
so
excited
awesome.
and appreciative. But yeah, Habitat's doing great things in the community.
So good to see you, Curtis, and thank you.
Mm-hmm.
I will say, I know Fabian is also here, and Curtis was with NPHS previously. So NPHS is one of our collaborative partners as well. Actually, NPHS was the partner for the most recent one that Jay was at, and it's not the only one. I think we did two others with them, and I think that's what's most important. And I think there's the impression that nonprofit developers are competing because we're fighting for the same funding. So I totally get that. But if not for NPHS, NHSIE, Cal Home, all the other programs that we've used, these projects would not be possible. So I think, we've done it and we want to make sure that we're able to continue to do it. So I think I saw Lift to Rise there. I think there's other folks on here that we haven't had a chance to work with yet, but I'm hoping that maybe in the near future.
Well, partnerships in the name. Love working with you guys.
Nice. Well, thank you, Kari, in presenting and sharing on that. I know I wanted to definitely elevate. I always like to spotlight when we have just great opportunities, when great projects come together, and it's happening all the time, and it's important that we elevate those to to continue to work past these challenges that we might face as it becomes more challenging to be homeowners. So I appreciate you coming and sharing your work and the story. And I as much as I would like to take credit for how great this demonstrated collaboration, I cannot. But I really appreciate just the collaboration in our region demonstrated throughout the panel, throughout you sharing this too. And so if you guys want to continue talking about this, we really anchor our wealth building conversations in our wealth building and preservation pillar that Jay leads out for us. So let me know, reach out to myself or Jay, and we can join. We could add you to that monthly meeting to continue the conversation towards ensuring there's financial resources in our region to build wealth through home ownership or through financial tools. How do we use those financial tools to attain affordable housing, to secure safe, decent, and affordable housing? So I wanted to just put a reminder that it was in our newsletter this next month in July. We always pause and take a break as most people are on vacation, attending conferences, doing stuff. We like to take that break to just settle in and re-strategize, not re-strategize, but just to plan really for the next 6 months as we move forward and start coming out of summer and entering fall. So there will be no pillar meetings as well as our monthly meetings in July. So I look forward to seeing all of you in August. And if there's anything that we can help connect you to with our pillars or monthly meeting, you're not yet on the series, you just came to this meeting, let me know, just reach out. I'll drop my email in the chat, or you could just easily find it floating around sometimes, but I could connect you all. So we'll open this last like 5 to 10 minutes out to just general announcements from anyone who might have anything they want to amplify, comment, and ask. Okay. Well, I appreciate you guys hanging on. Oh, sorry.
Yeah, I could just add a couple of things real quick here from the wealth building pillar and the also our sponsored coalition, the Bank on Coalition for Inland SoCal. One important thing that a lot of people overlook in getting started preparing for home ownership is actual ownership of a uh, checking account, a transaction account in a local credit union or bank. There's about 1 million people identified by the FDIC as considered unbanked or underbanked in our 2 county region. And these people cannot present 6 months of bank statements when Habitat or Credit.org or NPHS or any of our other great partners out there want to start working with them. So they have to send them back to kind of start over the process even earlier than most you would think, with 80% of our population, but about 20% of our population does not participate in any type of traditional financial transaction accounts, and they need that. So definitely contact us if you want to find out how your organization can begin to help people to take advantage of safe, affordable accounts available at around 500 different locations around our region. And finally, as we're getting ready to celebrate 250 years of independence, of freedom from taxation without representation, the whole thing about the Tea Party in the Boston Harbor, that was all about taxation without representation. And so we want to make sure that we are not falling back into a new form of taxation without representation. And the way you'll know that your clients are suffering from this is if they answer no when you ask them the question, can you vote in the city where you work? If they cannot vote in the city where they work, it's likely that they are suffering from a new form of taxation without representation. And it could likely also be a new form of redlining, I should say, that is sneaking up on us. So please encourage many of our local leaders to find ways that they can help prevent this from recurring 250 years later, and making participation in our local communities a reality for them, because homeownership touches almost all aspects of a person's life, their health, and their not just their finances, and their ability to participate in the local economy and the local government structure. So thank you.
All right. Thank you, everyone. I look forward to seeing you in August, if not sooner. Take care.
Thank you.